Chris Pulver here, just after 3 p.m., May 8th. Happy Thursday. U.S. big recovery plan. Well, we were waiting with bated breath all week for Trump to announce something. He was on the calendar today at 10 o'clock. I think about 45 minutes later than expected, we saw something on the headline, which was UK, US, announcing a big, beautiful, most magnificent, bestest in the Westest trade plan in the world. I don't think we can ink something literally in the next 60 to 90 days, but at least there's talks in the works. I think what I wanted to discuss is something I've been following the last few months with 42 Macro and Darius Dale. Interesting points on paradigm A, B, and C. Basically, what this means is the Biden administration post-COVID was thought of as a K-shaped recovery, right? Meaning that we have, those that have assets continue to benefit. Certainly, the housing market going up, stock market going up, Main Street, basically just having stagnant wages and higher inflation. Life got more expensive the last 4 or 5 years. That was the K-shaped recovery. Paradigm B is supposed to be the plan that Trump and co were rolling out this kind of level the playing field to narrow the difference between Main Street and Wall Street. That was going according to plan until the bond market broke on April, basically April 7th, 8th, and 9th. And you can see the backpedaling that happened from there. The day that the day that we'll all remember from April 7th's bottom, Liberation Day announcements to the good time to buy post that ripped the market up. Some of the biggest single day moves we've had in history. So here we are now with this big recovery plan. I want to talk about the charts and the structure. I think that we do have some bullish patterns in the making. I would expect to have a pause or at least a pullback to hopefully give buyers a chance to participate. But I think the reality is what we're going to see is we're going to see fiscal spending. We're going to see a Fed continue to do something like cutting rates. This may or may not be good. The Fed cutting rates may be in the, followed along with yields going higher. But nevertheless, fiscal policy will continue as opposed to being cut. I think the idea, this great goal of Doge and trying to cut $1 trillion+ from the government fat is just not happening. I think we may have cut $100 billion, $150 billion. And that could be the extent of it. So if we have Doge is pretty much done, and we have a tax cut bill that's coming in the next maybe 30 to 60 days, if that's bipartisan, great. I would imagine it would be in some capacity. It's probably going to be stuffed with all sorts of stuff that we don't know about. But something's going to have to pay for it. Somebody's going to have to pay for it. Our deficits will pay for it. Our deficits will continue to grow. And then you have this big shift into, we want to have AI leadership. We want to have energy independence. We want to have the biggest and baddest economy in the world. We want to automate everything. We want onshore manufacturing. All these are big, grandiose plans. But I think the reality of this is look out 10 years, and most likely what we're going to see is this will still help the top, not the bottom. I think this net narrowing is going to be minor, if non-existent. If we're lucky, we will see energy prices come down. We will see housing prices come down. I think housing prices come down versus rates go down. And meanwhile, if you're long assets, you're probably going to do pretty well. So I think technically we follow the charts. I put here, on the screenshot, prepare for a bubble. It wouldn't surprise me if we don't revisit the lows from April, that we do get up to all-time highs. There's some momentum and steam behind it. The whole administration will be celebrating the highs and all-time highs. We lead into bubble-type territory, and eventually it doesn't end well. But this is no different than what we've been experiencing since 2018. If traders have been watching from 2018 to now, if you've been trading since 2018 to now, you have seen some of the most ridiculous, inconsistent markets over the last 30 years. I mean, 2018 was a vol crash that melted back up to highs, crashed again, melted back up to 2019, 2020, crashed again, melted up to 2020, 2021, crashed again, melted up in 2023, hiccuped in 2024, crashed again this year. So if we melt up again, most likely we're going to be met by another crash. So I'm not going to call that top. I just want to be ready for it. But I think we have some ways to be participating if this market's able to get through this window, get through this noise, get back to all-time highs, and hopefully positioning my portfolio accordingly, as well as having downside protection. That's the most important thing, is managing risk. Um, and then upside is fairly straightforward. So that is the discussion for today. Here is the intraday price action. We had an interesting morning. I posted this in my Telegram channel. So in my Telegram channel, just ran a little errand and posted a video on how today's daily profit play went, some things I've got in the works. I'm going to give you a first sneak peek at something. I have a scanner that is likely going to be going live at the end of this month. This is something I've been working on for the last 4 months, and just kind of getting the visuals down, trying to make this as simple as possible. Get ready, get set, and go. Trying to find very simple trade ideas. For me, this takes hundreds and hundreds of ETFs and stocks and tickers that I follow every single day, and tries to give me something actionable. So I'm looking forward to sharing that with my followers in the coming weeks. So get ready for that. And here we are for the daily profit play with price action this morning. This is literally the entire morning. We sat here waiting for Donald Trump to have a 10 o'clock announcement. Prices were really sticky this morning. We pretty much put in a mock trade. It was I didn't take the trade live because I wasn't really sure what this announcement was going to be. I saw that it was something to do with the UK-US trade deal. I wasn't sure if the market was going to rip, before or after. And we sat and watched this trade that we typically take daily profit play around a 280 to 285 credit. And the entire morning we sat here watching. Nothing happened in the SPY, nothing happened in the SPX, and our prices still didn't really change. So, I mean, I don't know how this trade would have worked out in real time. I know that there were some traders in the room that did take some trades and took small profits. We usually go after a 15 to 20+% profit for the day, and it would have taken most of this session. I mean, this is after 11 o'clock, so you're in the markets for almost 90 minutes. Maybe coming back to center, that may have offered up a chance to get some profit, maybe. But the problem is we had a directional move from 56.40 all the way up to 57 and change. That's what I was trying to avoid. So I think it was a good thing we didn't force a trade today. We're still 5 for 5 for the week. What we did instead, and I issued this for my double up service, is we put in a butterfly spread at the SPY 570, and that'd be right here. And the SPY 570 was hit. We had a 570.29 high, and that allowed me to turn a 22-cent debit into a 50-cent winner. So cleared over 100% on that one. The other trade I took was an 8-cent debit that I'm going to lose on. So I'm losing 16 cents here, and I'm gaining, let's see, that'd be 16 bucks, and I'm gaining $100. So actually, I take that back. Net profit would be 28 cents. Yeah, net profit would be 28. So 56 bucks minus 16, still making 40 on the day. So I mean, it's fine. It was a good trade. But that's also losing one side, winning one side, and turning in a net positive day, which for 0DT, I will take a positive 0DT day any day. Okay. Telegram. Yep, I'll share that. I've got the Telegram link right here. So also I get this a lot. I see these YouTube comments like, Chris, you share your Discord, share your Discord. All I say is join me live, ask me to share my Discord, and I'll share my Discord. I always post a 30-minute link because I don't want that to be sitting out in YouTube. I get too many bots and imposters and scammers and crap that's out there. So I will post a live link that's available for 30 minutes and then it's expired. So if you want my Telegram, Telegram's easy. If you want my Discord, ask and I'll post the Discord, but it's going to be good for 30 minutes. So here is my Telegram to follow. So Chris Pulver, Telegram. There you go. And if you want my Discord, I will post it, but I'm going to give a 30-minute link, so you got to be live here for the day. There we go. Bob Pete says, today took daily profit. I took 61 minutes of the 15% profit. Okay. So did you get in right around the open, Pete? Just after the open, like we typically jump in, and took over an hour, so about 10:30. Yeah, I mean, and that's fine. That would have been after we closed up the session. So, I mean, I'm glad you hit the 15% profit. If you waited a little bit longer, I'm sure that was still offering up 15 to 20% before the market started to make a directional move on the day. So, anyway, that was the price action for the day. The butterfly spread worked out well. I had also a follower email me. Let's see here. was it Penny that emailed me? Yeah, Penny emailed me about the butterfly spread. I want to bring that up here. So this is the trade that I had running today. It was taken this morning. Let me see when I took that trade this morning. I think it was during live session. I took it at 9:44. So this isn't going to reflect the entry price, but now that we are here at 3:14 in the afternoon, here's 3:14 in the afternoon. I guess it's now. And this trade is showing even on the original trade, it's showing 44 cents. We're trading at 68 right now. Let me just check the price. So here, it's still trading for 40 cents. So if you're still in the trade, you have about 100% gain. At one point today, when it was up to 570 and 569, you had about a 70 to 75 cent credit, which remember the debit was 22 cents. So what I wanted to show is Penny was asking, how do we manage these butterflies? I had a big discussion this last week in my double up service, which is where that trade got posted officially. And my daily profit play, we're live every single day, so I sprinkled that in as kind of a bonus. It's not our typical strategy for daily profit play, but things were different today with the economic calendar, Donald Trump, and the 10 o'clock news in case it was going to be a big directional move. So I wanted to avoid that. Anyway, long story short is the butterfly spread is this, and I've had a lot of sessions on YouTube where we talked about this because sometimes I have broken wing butterflies and butterfly spreads going into the end of the day. But the profit trap that you see here, yep. So the profit trap that you see here, right now, this is where the live P&L is. The profit trap is at the end of the day. So for this thing to actually show the big gain on the day, you want to see this all the way towards expiration. See how this grows? So if price, and this is a little bit delayed on option strat here, but if this is price, let's say that this white dotted line shifts over into the middle into this profit trap area, right? This would be my break even on the downside of price. This would be my break even on the upside of price. If we're in this profit trap at all, going towards the end of the day, butterfly spreads, the reason I like them is they're very cheap to get into. They have a huge profit potential, and we don't have to sit and wait until expiration. Okay. So what happens is if we are anywhere near these profit trap levels by the end of the day, you can see that time and price cooperating in your profit trap as time gets closer and closer and closer to expiration, your P&L is becoming more of a reality and starting to line up with the actual risk graph, right? So, and look at how long this takes. At the end of the day, if you want to get that profit trap, this is estimating 3:45 p.m. So this is out about 30 minutes from now. You go to 3:50 p.m. right? And you got to be like right in the middle here. If we see price between around 569 and 571, you're still getting a good return on capital. This would be showing probably 60 or 70, 60, 70, 80 cents profit on a position that only costs 22 cents. That's a really good return, especially if I took 2 contracts on the trade, so made $40 on it. But if we go, I guess I made $56 on it because it was 50 cents. So anyway, as we go to 3:50 p.m., like these last crucial minutes, look at this thing at the end of the day: 3:51, 2, 3, 4, 5, 6, 7, 8, 9. It's like this is like literally the last 5 minutes of the day. The last 5 minutes of the trading day is how this thing peaks. All right. So for everyone that's thinking, man, this butterfly stuff, I love this trade because I can get this huge 10-to-1 profit. No, you can't. You can get it if you are spot on at the end of the day. At the end of the day. And when I say the end of the day, I mean like literally the last 5 or 10 minutes of trading. Okay. That is not easy to do. You have to be mostly lucky to have the market pin perfectly at that price, which in this case was a 570. If at the end of the day this is sitting at 570, then we are so lucky, and we'd have a max profit in this trade of about $300. Okay, or actually about $200. My fault. So it was a 568 and a 570. So let me type this out. So this was a buy a 568 call, and then sell a 570 call with 2 contracts, and then buy a 572 call with 1 contract for 22 cents debit. So that was the trade. Okay. Now that trade is still trading right now for about 45 cents. Okay. And let me get my calculator out of the way. So this trade, so I closed for 50 cents credit, which means 22 cents minus 50 cents. And what's my net profit? 28 cents profit per contract, which is over 100% return. Okay. So 28 cents, 28 divided by 22. So I made 127% gain on that trade. That makes sense? So it was a 127 return on risk for that butterfly spread. Now the trade offers a max profit of $2. Okay? Max profit would be $2. The only way you're going to achieve max profit, okay? The only way you're going to achieve max profit if SPY is exactly at 570 at the close. Okay? That's the only way. Now, because it's SPY, not SPX, because it's SPY, not XSP, these are trades that I still like to manage in the end of the day. Right? I don't want to have the broker have to settle this. There shouldn't be an assignment, but if it's in between strike prices, it should be settled. But somehow, I mean, there are shares involved with SPY. You know, it should be, I mean, defined risk inside a butterfly spread, it should just settle because it's essentially a debit spread and a credit spread. But if price is on the other side, if price is like 570.01, 570.05, that sell call would be part of my credit spread, and the broker may assign me negative 100 shares by tomorrow. So this is a trade that I want to be out of at the end of the day. And you can see how critical it is to get out of this trade before 4 p.m. Eastern time. Okay. So max profit's $2, which again is about a 10-to-1 profit, right? If we had a max profit here, and this is perfect world, $2 max credit, that'd be a perfect trade. It's pinned at 570. You close this thing out at the very, very, very end of the day. Divided by 22 cents, that's a 900% return on risk if you get it spot on. The reason I take these trades is not because they offer 9-to-1, 10-to-1, 20-to-1, 30-to-1 reward to risk. What I'm after is because the reward to risk is so much in my favor, it can offer that much return on risk or return on capital, but it's going after even a 1-to-1, a 2-to-1, a 3-to-1 is achievable. Right here we are again at 569. This trade right now is trading for 67 cents, 70 cents. If you can close this down for 70 cents, 70 cents right now minus the 22-cent debit, you're up 218% on that trade. Again, return on risk. That's a good trade. So we are back around the peak. This is delayed right here. Once this dotted line would get back into my profit trap, we're trading around 569.05. So that puts us right around here. Yeah, so right around here. 569.05 is in my profit trap. But that's if we go all the way to expiration. So right now it is 322. So let's roll this back to 322. Because that's now, right? So this is basically now, and we're trading around this 569.20. So this is where we are on the curve. Okay, in real time, this is about where we are. So I mean, seeing 70 cents credit is great. As we come to the close day in the next 37 minutes, we'll see exactly where this thing is at. You know, maybe these last few minutes we can see this trading for $1 credit. Right, so a 22-cent debit that you can close out for $1 plus. Your max profit's $2. If you're paying attention to this stuff, you can get that opportunity to kind of get that pin price. Okay. So any questions on that? The reason I explained this a lot, we had a whole class on this in the double up class last week. We did an updated master class. This is an easy way to be trading. I don't necessarily want to pick both directions when I take these trades, but today I had such a wide level between 570 and 550. I'm like, well, I'm going to take a stab at both and see which one can close out for more than 100%. So the idea was to net a positive day, and I did. And the reason I like these trades, so why do I like the butterfly spread? Because let's say a 9-to-1 or 15-to-1 or a 20-to-1 opportunity can offer 2 to 1 or 3 to 1 intraday. So we don't have to wait all day for the final, 10 minutes or, 5 minutes to close. So you don't have to sit at your computer, wait all the way to closing bell. Plus, it's a little bit less liquid at the end of the day anyway. Prices can jump very quickly. You can also see prices blow through your levels. I mean, if you look at April 30th, if you look at what happened yesterday at the, final hour, literally final hour yesterday, was price went up 50 points in the SPX and dropped down 46 points and then back up again another 20, 30 points. That's a lot of moving and shaking in the last 30 to 45 minutes of the day, right? So my goal is when I have such a big profit opportunity, I'm happy with a 2 to 1 or 3 to 1 reward to risk. I'm actually pretty stoked about those because that's enough. Even if I took one trade on the day, that's a great return on risk. Great return on risk. If I take both trades where I'm looking at a put fly below or a call fly above, as long as I can clear 100+% on one of those trades, the loser is absorbed and we walk away net profitable. Make sense? So if you do like equal risk, if I was risking $100 on the call side and $100 on the put side, as long as I can make 125, 150, $200, I can take the loss and I can net out positive gain on the day. Make sense? Okay. 57.50 on ES would more than pay for yesterday's BS. I mean, what are you saying? Yeah, Penny's got the exact trade in. Yeah, you mean 568 Penny, not 268. But yeah, 30, 60, 30. That's awesome. So debit of 480. Yeah, and you said you closed out half the trade, right? So you got half the trade. The rest is kind of running risk free. I mean, Penny, you might be able to have that second half of the trade if we hang out around that 569 level, between 569 570. If we hang out there for today, you're going to turn that second half into a nice win. So again, now is 520 or 326. So this is updating. Price is a little bit delayed here. We're trading live. Live is 569.06 right now. So this is about where we are on the P&L. So right in this area, just above 569. So we're in the profit trap, which is good. If we stay here kind of above 569, between 569 571, that's going to be a pretty good looking profit trap towards the end of the day. But as I said, the final 33 minutes is when this thing will really start to grow. This really gets steep and aggressive those last like 10 minutes of trading and the last 5 minutes of trading especially. Okay, so yeah. So I just want to ask a question. This will probably pop up in like an AI short, butterfly spreads. That breakdown makes sense? So if you want to learn more about that and go into like full details, we deep dove into that last week in my Double Up Alerts masterclass. So you can check that out. And like I said, we sat on the sidelines for the daily profit play today because Trump was on the calendar. This big surprise announcement that he's been talking about all week. I thought it was yesterday. I thought it was yesterday with the AI, the AI curve, and all of a sudden we had Nvidia up, and SOXX was up, and SMH was up, and Micron was up, and AMD was up, and all these chip stocks were leading the way. We gapped up higher today, and then we had a UK US press conference essentially. I don't think that a deal is necessarily done. It's going to take months, if not longer, to officially hammer out the details. But who knows? And I'm also wondering like who else is in line. So let's go back to the screenshot here. Paradigm A, B, and C. If you want to get more details on this, one person I recommend following is Darius Dale at 42 Macro. Every day on Twitter, he has a really nice like macro minute and just does a short like 7 to 10 minute video. And he has been talking for a lot of his macro clients, Paradigm A, B, and C. Paradigm A was essentially the Biden administration. K-shaped recovery, post-COVID, fiscal spending like almost to a fault, while the Fed was, slowly cutting rates, but fiscal policy was aggressive and benefiting the top, right? Paradigm B, and I'm just repeating this from the very beginning of today's session, Paradigm B is what Trump and co planned on doing, which was to kind of equalize or level the playing field, which is take a little bit out of the wind out of Wall Street sails, benefit Main Street by lowering rates and maybe pulling the stock market back a little bit, or at least trying to see some see some short-term pain for long-term gain. I know we had to deal with it. We obviously had that with Liberation Day. We had a trade war going on. But what I'm telling you is Paradigm B broke. Paradigm B was a plan that broke. Okay. And the reason why it broke is because the bond market, and you can see this here with the yields, if you go to TLT, which is the 20-year treasury or the 20-year bond, when this thing snapped, let me change the colors here. When this thing snaps this way, and that is ridiculous price action, by the way. Like, this is supposed to be one of the most liquid markets in the world, and this was trading like something broke. Okay. That was almost a 10% decline in 3 to 4 trading days. So you take that type of volatility in the bond market, you take on the 10-year note, the US 10-year, okay, you take the yields going higher, doing the exact opposite, right? When bonds go down, yields go up. This thing shoots up 72 basis points in about 4 trading days, like the most aggressive move on record, okay? That's the breaking point. So this is what I think caused Trump to backpedal and say it's a good time to buy. We had a 90-day pause. And what did that do to the markets? Well, the markets obviously surged aggressively on that announcement. Here we are still going sideways. Yields are still elevated. Yields are still above Liberation Day levels. And I don't think this is going to change too much. I don't think that the Fed cutting rates is going to bring this down into fresh lows. If that is the case, if the Fed's going to cut in July, we should see yields go down to these lows before they started to cut back here in September. My concern is that that doesn't happen. My concern is that the Fed starts to cut rates and yields just slowly or quickly, right? They start to rally. This would attract more debt. Okay, this would probably make it more attractive to own U.S. debt, whether it's 10, 15, 20 years, whatever duration the U.S. tries to come up with. But if yields go higher, that's not a good sign for this liquidity air pocket, this borrowing that everyone's going to be facing in 2025. That's why I am cautious moving forward, okay? But yields are just one piece of the puzzle. And if the U.S. government right now, if Trump and co. are still going to go back to a fiscal spending regime, then we're more along the lines with this paradigm C, which is the government's still going to spend. The Fed is kind of backed into a corner. They may cut rates to be somewhat more accommodative, but the yields may not cooperate. The Fed is going to navigate a very slippery slope. I think if the Fed cuts, I don't think they're going to cut aggressively. They may honestly try to push the cuts further back to maybe still have 1 or 2 cuts this year, but push them back instead of cutting in summertime. Or they do cut and they just, according to their CME watch tool, things kind of fall in line with a July cut and maybe October or December. But the reason I said prepare for a bubble is because if the government's going to step in and spend just like it did during the Biden administration, then look at your SPY levels. Okay, all I'm asking for this market to do is give this, right? If we have a topping area here, let me draw this out a little bit differently. If we have a resistance zone right here, okay, which means we can still melt up a little bit higher, right? I would love a pullback, and maybe it is. I mean, what's funny about the market sometimes is it can seem so ridiculous and so scary, but if you just take a step and look at the technicals and zoom out on a bigger time frame, it's not that hard. This resistance offered up support. Pretty simple. I took a lot of stabs in these lows. I know it was aggressive and I was selling a lot of premium and it was scary and I had a ton of volatility and I was taking out a bunch of drawdown with open P&L and my option positions, but within 30 to 45 to 60 days later, lots of profits. So, I mean, right now it's been about 30 days since these lows. And I had trades that were 30-day expirations, 45-day expirations, 60-day expirations, and most of those profits were achieved. I didn't take full profit, but I'd say most of my trades that I took off as far as credit and max credit was anywhere between 55 and 98%, 99% credit. So there's a lot of profit, which I'm happy with. But now let's zoom in for a second and see like how technically obedient can this market be? If we connect the highs right here, okay, is it possible that we have resistance in the near term, okay, and then we have a pullback that can pull back into a gap level and find the backside of this trend line? So I would say this, like I'm looking at the SPY now, but if we pull back into 540 or 530 area, I think that's a good opportunity to look to get long. If we pull back a little bit deeper, like a 510, I'd still be considering longs. So do we get long in here? I think that's a good looking trade. And do we get long here, or do we get long here? Either way, I think if all-time highs are in the cards for later this year or into 2026, then I want to see, opportunities to buy, buy, and buy. In the timeline, I'm still waiting to figure out how far out I want to go. I can obviously take some more near-term expirations. My waterfall service, we can go out 45 to 60 days, which you do in a lot of those swing trades and get those profits. But as far as tilting my portfolio, I would say if I went out 6 months, 6 to 12 months, I have a good kind of feeling that if we're going to be back to these highs, that's a good enough window to capitalize on that, and also take like little bites consistently through maybe Q1 of 2026, maybe May of 2026, right? So look, if the market offers it, I'll go back to this initial trend line. If the market offers a pullback, that's all I'm looking for. We've had a nice little melt up, low to high, higher low to higher high. It's very close to symmetry. Okay, we get a pullback. Look at a retest of equal lows. Look at a pullback towards the backside of the trend line. If the market holds there, let's see if we can make that a turning point and then start to see some new highs get created. We start to clear this 200 moving average. We start to eyes on that 200 moving or eyes on the all-time highs, and to the upside. This is what I'm saying. Like prepare for a bubble, right? Because if we have, and all I'm doing is connecting these recent highs. If you connect this high with this high, right, and project that out, I mean, we're talking like a 670 SPY. Round number would be at 700 SPY. So if the SPX hits 7,000, it doesn't mean I want to call the top. I'm just saying that could be a massive topping formation, and this market may surprise us with something bad. We get all the way up here. We have this big melt up. Everyone's excited. But what could change it? A big, ridiculous topping pattern. And then the floor falls out, and we've got a long ways to go where there's no real structure. And again, we would deal with the same thing we dealt with for the last 6, 7, 8 years of trading, which is we make all-time highs and everyone's excited. And then this thing drops another 30 to 35%, and we start all over again. And so, yes, the dip buyers could be rewarded for that, but it is so frustrating to be left holding the bag at these tops and having zero protection. Does that make sense? Which is what I don't want to do. So that's why hedging is important. That's why risk management is important. That's why having some asymmetry to the downside is important. Look, I have a handful of trades on that are for protection. They offer up, like I took a trade today on the Russell that offers up I think a 15 to 1. So my risk is about $510. My max profit is 14,510. So that's about a 28 to 1 reward to risk. I have a trade on ES for the S&P futures at a 44 to 1. Those trades may not pay me ever, but if they do, they pay in such a big way that it could help protect, a lot of my positions that I'm in. All right. So risk management is kind of key, and it's helpful for me to use the futures market to be leveraged, right, where I need it with defined risk. So that is that. 30% drop like that would be crazy. I mean, it's not crazy though. I mean, you look at this. Look at what this market has done since 2018. What is crazy is the fact that we have been literally in a boom and bust cycle for 7 years. You go back to, 2000. It's not that crazy. You go back to 2000. You had a lost decade of gains because you go from 2000, crash down here for a couple of years, come all the way back up after a 4 or 5 year melt up. We get up to 07, 08. Obviously, you know what happened there. Another crash back down to the same lows, if not lower. And then we have this crazy, hey, the Fed is the most powerful thing in the world. And what are we going to do? We're going to backstop and quantitative easing and near like zero interest rates. We're going to bail out the banks. And it was just the most ridiculous bull market that this thing has really ever seen. But we ran into some hiccups along the way. 2015, 2016 was sideways. 2016 to 17 was a melt up. And here's where I'm saying the booms and busts have started. Now, obviously, it still pays to still be long and have a horizon that's going to be longer term up. But I just want you to see that, look, sideways here, this is 20% back and forth. Up here, down here, that's over 10 to 12%. This was a 20 plus percent correction. This was a 30 plus percent correction. This was a melt up to a 25, 30% correction. Here's a melt up to another 20% correction, right? So that magic number to still maintain this bull market is 20%. Anything beyond that is going to be breaching major technical support. And I think we can see here on this chart, if you just connect the lows right there, why do you think this market also bottomed? Well, if we didn't hold that resistance to become support, if we didn't hold this trend line support, then we literally break the structure of this bull trend. And that is why I think that even if we come back down to retest it, this market's going to make a higher low or an equal low. And that's a bear trap because I think the market still finds a way to get up to these highs. I don't think Trump and company want to see the markets retest April lows. That would show that something is backfiring if that's the case, right? Something would be badly backfiring if that's the case. So I think we're going to have higher lows, and that's why I zoomed in. I'm just trying to find something relatively clean right in here. I know my chart's a little messy with some of the fibs and the lines that I have, but if we just take this level right here, connect the highs to that March pullback, anything into 540, 530, even this low here at 510, I'm interested in scooping up some kind of bargains, right? If it offers up a discount, the bears might be noisy and they hit all the headlines, but is that a buying opportunity? Do they pull back a little bit deeper and gap fill? Is that a buying opportunity? Right? Backside of the trend line retest, is that a buying opportunity? All of the above. And I'm willing to take some stabs at the market. Now, I'm prepared, and this happens. I have a class called Crash Insurance Master Course or Masterclass, and if we somehow came back to the lows again, the nice thing is the hedges that I took here and the hedges that I took here, if we revisit the lows again, those pay extremely well, right? They pay really well. So I'd be taking profit on those hedges. I'd still be, selling premium and taking a stab at these markets at these lows and looking to see if this is another chance to get long, right? And for this time, I would be looking to stay long and probably trying to go more. Let's get to the highs, right? So what else we have? Yeah, look at Qs. I mean, it's all going to be the same, Tony. I mean, seriously, this is all pretty much the same. I mean, SPY looks like this. Here's an easy trend line. Draw the trend line right there. Okay. Backside of the trend line, if we get a pullback, we get a chance to buy the dip. I like that spot. Take the trend line on the Qs. Same thing here. Connect the dots. We pull back into some support. Same thing in this area. A pullback, a gap fill. That's a good spot to be getting long, trying to see if the Qs can get back to all-time highs. I hope, and I keep saying this, I hope we have a pullback. If we don't have a pullback, it's going to be a very frustrating way to participate in a melt up without having any real chance to buy it. Obviously you could be like, well, just buy it now. Well, yeah, but if I buy it now and watch this thing drop, 40, 50 points, that's a terrible entry. So that's not what I'm trying to do. I still have some tilt in the portfolio. If it goes higher, I benefit from that. That's fine. That's easy. Okay. But point is, watch the backside of the trend line. Watch for this to be a test. Look at the Dow. Same thing here on the Dow. Draw a trend line. So right in there. The Dow has, slowly made its way back into the 200 moving average. So does the Dow have a little bit less volatility, but we come back here and chop around at the backside of the trend line? And if so, do we then break and go higher? Does the Dow also hit all-time highs by the end of the year? But it's very possible. Okay, the Russell is the one that has the most room to make up, right? Russell's trading at 202 today. I talked about this morning in one of my YouTube sessions that I'm doing basically a campaign where I'm just buying IWM, selling weekly calls, and I'm just going to do it to generate as much income as I can. I think right now, as long as we're in a melt up mode, I'll just keep selling calls for maybe the next 4, 6, 8 weeks and see what I can accumulate from that without having the stock called away. So this is already out. It's a $200 strike and it's to next week's expiration. So I will wait. And if I want to roll it, I'll roll it another week, and I'll just go like 1 week at a time. And hopefully I'm pulling in somewhere between $200 to $300 a week. Okay. But here's the trend line. If this is going to really recover, then we're going to have to break, that trend line there, which it still has room to run into resistance around that 200 moving average. So if the small caps make their way up to the 200, you can see there's some pretty good resistance there, right? Hit the 200 moving average, maybe poke above, poke back below, but we have resistance, and we'd have resistance right there, which is price point around 210. So if we hit 210 and reject, that's fine. I have a Russell futures hedge down here. That's the $510 risk that pays potentially $14,500. I'm not going to make $14,500 on the trade, but because it has a good upside, even if I turn a $500 risk into $500 to $1,000 in profit, that basically for every $500 winner that I have here, for every $500 I have, that's lowering the IWM price per share by $5 because I have 100 shares. Right. So if I can get a $500 winner or a $1,000 winner here, then that's lowering my cost basis. And that's exactly what I want to do is just maintain, kind of my lower cost and try to drill this thing down as low as I can. Okay. What price to get back into QQQ? I mean, I think if we have dips back into the four, I mean, I'd love to see like a 460 or a 450. I mean, it may be somewhat shallow, but I think a 460 to a 450 zone somewhere in here would be a good opportunity to be looking to get long. We come back and fill this gap. There is another gap down here as well. But I'd say between 460, 450, some small bites, maybe going out 60, 90, 120 days, maybe even going out a full year. I would take my stabs at a trade like that. Because I think once this, if this makes a higher low, right? If this makes a higher low, then we have this potential left shoulder, head to neckline, higher low. This gets back up to the neckline. If that neckline breaks, we all know what that momentum looks like, and that measured move would get us all-time highs. So any dip and pullback, I do like right now. Crude won't stop making head and shoulders. Let's check out USO. Check out CL for futures. Yeah, look at that thing. That's. I mean, yeah, I see it on the daily chart back to 59. That 111. I mean, I'm glad I didn't take a big loss on the 111. I was down about $10 and I closed it out. But that would have been holding nicely. I don't know if that trade is still in here. See if I can find it. CL. Yeah, it's not in here. I closed it out for like a $10 loss. And whatever. It was a June 20th expiration. It would have been showing. I think my max profit would have been about $150. So it's fine. I'm not worried about it. Oil is a bit tricky. I mean, we're getting a lot of noise in oil. OPEC Plus and Saudi Arabia looking to boost production. U.S. energy are trying to flush oil and create a supply glut, but it's just not really happening. So I just think, as kind of always with oil, is it just establishes some ranges and it trades there, but it's volatile. I think it's a little bit easier just to not worry about it. I do have a trade on UNG that I adjusted today. So I have a diagonal spread right here. This one expired, so this 417 is done. I put on a 516 or a 530. Let me double check this on UNG. So down here, UNG, I put in a 19 call for, this is the 21st. So the 21st is going to be on a Wednesday. And if we're above $19, I still, make a few bucks in the trade. This brought my debit down. So let me update this. I'll go UNG. 1088 is the break even. So I've got now I have a 521 expiration, sell 19 call, sell 19 call, and that makes the debit $10.88. So that gives me about $3.12 a share if it's called away. And I'm going to try to continue to roll this one as well. So if price is going higher on UNG, I'm just going to roll this, and try to get some extra income. Just turn this debit down, get the net profit, and see what I can do with that one. So I'm out on this trade out until 2027. So it's really just how I can manage the sell side of that trade. Adrian, the other day you said markets don't take rate cuts nicely. I mean, they typically don't. I mean, you go back to when the Fed really started to cut aggressively, and I think that might be the difference this year is the Fed isn't really looking to cut aggressively into weakness, right? I mean, my concern is that we're cutting at all-time highs or close to all-time highs. The Fed is cutting into a weaker economy. That's usually not a good thing because what tends to happen is the Fed is reactive. The market's already kind of rolling over. The economy's already rolling over. And it's like the Fed is cutting in the wake of a recession as the economy is weak. Right now, the economy is showing it's resilient, it's strong. We've had these kind of rolling recessions where it's like not every sector feels it at the same time. And I don't understand why they'd want to still be cutting rates when we're sitting at all-time highs. There's no real need to cut rates. There really isn't. But if they're cutting rates out of this necessity to service debt at a lower price or trying to drive yields lower, I mean, I get the reason. But if the bond market doesn't cooperate and yields don't go down, that's like the pickle that the Fed is in right now. So I don't know how that plays out. And that is a reason to be cautious. But I think earnings right now is still coming pretty solid across the board. Earnings have been pretty solid. Market breadth has been reasonable. I mean, we're going back to, let's go to S5FI for the 50-day moving average. So we're seeing now about 55% of stocks are back above the 50-day moving average. I talked about this week because before this week started, we were still below. About 55% of stocks were below the 50-day moving average. How about the 200? Still about 60% of stocks are below the 200 moving average. So we're still on a broader scale. The market breadth is showing that we're still below a 200 moving average, which would be a sell zone. Okay. But if this starts to go higher, if this goes higher, where now all of a sudden we're at, 50% of stocks would be greater than the 200. Okay. And then let's say, 60% of stocks are greater than the 50. Well, then we've had a bit of a fix. And yes, they're lagging. And yes, it's late because we obviously, had to trade the bottom to get the best price. But if the market breadth is showing, hey, a lot of stocks are now back above into buy zone territory, well, that's probably going to be momentum upon momentum upon momentum and more buying. And the markets continue their melt up phase. Okay. Michael says you buy 1,000 shares of UNG at 18 to sell at 19. No. So I bought the trade. So if I go to UNG, I bought the $5 call. So this is a diagonal spread. So I bought the $5 call that my debit's now $10.88. So my break even on the trade is $15.88. I'm selling it at 19. I'll make $3.12 a contract if I do that. Make sense? And the way you're doing the math before is I bought it at $5 for $11.25. So 5 plus 11.25 is 16.25. My call was 23. I'd make 6.75 on that. So I'm trying to be more aggressive on lowering my cost and turning this into an income trade just in case oil doesn't really cooperate. I'm not going to hold this thing very long. Okay, I did the same thing here on TLT. I had TLT rolled out to July with a $96 strike. I don't think there's any way that the bond market is going to be coming back up here. This bond market broke. If anything, this bond market is probably going to be like a scalper's paradise because I think the lows are really important that we don't really go too much lower. But I think that the upside is very limited. If we're going to have higher stocks, we're not going to see the bond market act as any type of safe haven. So I went from, I was about 90, I was about 80% profit of my covered call, and I rolled it down to, I want to say 89. I'll show you the math here. So here's my TLT trade. So I rolled, there's my 96 call. I took about 76 or 77% profit out of that trade. I rolled this down in time and also down in strike to an 89 call. This gives me a break even if I go to TLT here. So TLT gives me a break even of around $20.82. So my break even is 28.2 plus the 65 call puts me at a break even of 85.82 minus 89. If price were to go back above $89, then I make $3.18 per contract. Now I'm in most of these accounts have like 4 contracts, so that would be times 400. I still make an income trade of $12.72. So all I need TLT to do is get back above $89. But if it doesn't, I'm just going to keep selling aggressive premium, lower the cost basis, and just try to generate an income trade. Right now, this trade is, if it plays out the way that it is right now, that'd be 1,200 times 11 accounts. It's about a $14,000 winner if it gets called away for this round. So end of May, if we're back above 89 for whatever reason, then I get paid about 14 grand. The more I can chip away at this, like 30, 40, 50 cents, the more this bottom line increases. And I'm going to hopefully, if I can, I'll try to make as much money as possible. But what I'm not trying to do is sit on TLT like it's a great trade. I don't think TLT is a good trade at all, right? I think TLT, if you're lucky, you can scalp it down here to be long. But my concern is that if we don't hold these lows, and this is another reason too, I mean, the bond market might act as a little bit of a safety net if the stock market dips, right? So if we have the pullbacks in those levels I'm talking about, if the SPY pulls back, if the Qs pull back, if IWM and DIA pull back, then I could see the bond market acting as a bottom here and then popping up maybe a couple of bucks. Well, that would be enough to give the equity market a pullback. And then as soon as the equity market catches a low again and catches bid, then bonds are coming right back down. So I don't want to be holding this thinking we're going all the way up. This is a great trade. I don't want treasuries at all in my portfolio. What I thought was a good trade to go into the year, this has essentially scared me out of it. This bond market breaking, I don't have a lot of confidence that yields are going to go down to see bond markets go up. I think it's going to be the exact opposite. I think that yields go up and bonds continue to be suppressed lower. But I'm hoping that we at least have a floor here that's going to be, look, this is when, Trump and company kind of had the market break on them right in here. So if yields continue to rise, you're going to see pressure on the bond market. They're looking to raise debt. They're looking to raise on those auctions. They're looking to, fulfill their obligations to grease the wheels and keep this debt machine running, right? So we need buyers of our debt, and that's going to put a lot of pressure on the bond market. Okay, cocoa. I don't have the ability to trade in Tasty. I mean, I like to trade for cocoa. It'd be CC for cocoa futures. I mean, I'd have to open up like a Ninja Trader account if I wanted to trade it. I'm not that interested in it. I do like cocoa up to these highs. I think if we have a run to these highs, I think cocoa is going to be a fantastic short. But I would be extremely patient. I mean, if we've got some aggressive cocoa traders, maybe that's the trade. But I would look to just trade this range. If we come back to resistance, I'd be looking to sell it. That's a big profit potential right there. So, but I don't have it. It's not in the Tasty platform, so I don't trade it. Let's see here. So, Michael, you get on that whole idea with UNG. So I'm doing it as a diagonal spread. My call is really deep. It's a deep in the money call at $5. So I'm just tracking that plus the call away and the debit, so I can get my net profit. Okay. All right. And as I'm talking about this, here is the market right now, just giving back what it gave us today. So we were up to resistance around 570. We're now down to 564. No major news, just a little bit of. I mean, look, it's funny how it says like, oh yeah, U.S. UK trade deal rebounds. It's like, no, we didn't. We're right back where we started. Markets are still showing green today. Like, oh, S&P's up 0.6% today. Well, look at price action. They gave it all back. So I think we're still in a chop zone right here, and there could be some support along the way. This is a trend line connecting the lows. So if we connect the lows, there's still some trend line support, but it's just not that hard. Like, pay attention to this market may come back and find this gap. This market may come back and find this gap. Okay. But I'm looking at those as buying opportunities as opposed to I want to short the market. I want to be. I really don't. I'm hedged. That's fine. If we surprise to the downside, I've got hedges that will pay really well. Otherwise, I'm interested in buying some dips in here. It's that simple. Right now it's going to be that simple. Now I'm not going to go crazy hog wild on the risk. I'm going to take some bites. I'm going to do some debit spreads probably. But I'm watching. IWM is trading a little bit lower right now. And next week I have a call at 200. So if it does not get called away, great. I'll pull in my 385, which I think I took on it today. So if I go IWM, I took 290 credit at a 200 call. So it's about $300 that I could pull in. If I have to roll it, I'll roll it out another week from the 16th to the 23rd. The nice thing on IWM is there's more expirations. So I could be a little bit more aggressive on when to sell, but I think weekly is good. You get about what I'm seeing right now with the current volatility is about $200 to $300 per week. So that is the plan, to just keep rolling and generating the income. All in all, I mean, my goal on the IWM, depending on how choppy it gets, would be if I can turn, every account for, let's say, $1,000. Well, that's $11,000 on IWM. If I want to keep that campaign going, it takes me another couple of months. Maybe I can make, $20,000, $30,000. I did the math. I just shared this in my Telegram video today. This little video right here. I did the math yesterday. I'm like, well, if I did 26 weeks of this, in theory, it's not going to be perfect, but in theory, this could potentially help me generate about $100,000 on IWM, selling calls around $300 a week. Like, that's a pretty attractive proposition for my portfolio to have something that's passive income, that's actively traded, but fairly consistent. And what I will do is I'll miss out on like this crazy upside rip. So if we do see the IWM like rip to the upside, then I'm essentially just gonna have to get it called away. And if I want to start the campaign over again, that's fine. But there is a fine line between chasing a run and going out like I'm just gonna roll my cover calls out to December. Nah, I'm just going to roll it like a week or two, get some income. And if it works, it works. Once it gets to it where I'm disadvantaged, where it's like I got to roll it for a debit, then I'm just going to stop rolling it, let it get called away. Okay. All right. So there you go. So there's IWM. We are giving back most of what we produced today. SPX is dropping pretty hard these last few minutes. The other, butterfly spread, I still have that running. This is a SPY trade for the day. It's likely, it's worthless 1 minute before the close. So this is going to close for nothing. This trade here, yep, it's worthless, which is fine. I still have the other profit from the previous one on the upside at 570. This trade, you're going to see that now we're trading down to, 565, which is way down here. So if you didn't manage the butterfly spread today, Penny, or anybody else that was in my double up service, if you didn't manage that butterfly spread today, guess what? That's now a loss. That's why I don't try to take this thing and try to get that 9 or 10 to 1 profit. I try to get, I'm up 100%. I'm up 150%. I'm up 200%. Take the profit. It's a good way to do it. It's a great trade. Getting 9 to 1, 10 to 1, 15, 20 to 1 is so slim. It's great when it happens, but it's just not that common. So take your profit when you get it. Anything over 100% is pretty damn good on a butterfly spread. All right, there we go. Been waiting on a Bitcoin pullback. Yep, I know. And that's fine. It just marches higher. And look, don't be upset. I mean, dude, Bitcoin going higher is good. I think it's great. Yeah, I didn't get a chance to add much, but I did. I took some stabs here. I put some stabs in here. And so I'm benefiting from that run. I have some income trades running on IBIT. Some income trades like a 111. I've got some naked puts that I sold as well. All those are looking pretty good. If we get up to the highs, it's not a bad problem at all. So IBIT is up around $51,000, and I have a bunch of shares. I've got it covered at 62 out to next Friday. I don't want to get it called away, so I don't know if I'm going to sell covered calls on it. I really don't. I have there's a bull put spread which is out a while. That one's probably totally fine just to let it hang there. Then a 111. This one's up around 63% max credit out to June, which is only 43 days out. So I'm probably going to take profit there. When we're, if this is 76 cents, if I can trade this for less than like a, 10-cent debit or 5-cent debit, I'll close it out. Cover call at 62, cover call at 62, bull put spread, same thing here. Let it sit. This is a 111 income trade, cover call at 62. I'm just going to try to pull the full income in, lower the cost basis, and it's a lot of. I'd say it's exposure, but like this, for example, naked put combo 31 to 28 on IBIT. I'm only up 23%. I potentially have an income trade here of about $469. If I can get 400 of that, then I'll take the profit. So watching. But there's some IBIT exposure. I'm liking this run up in Bitcoin. If we don't really get a pullback, and that's what I don't know, is if we don't get a pullback, then this is a melt up, right? We melt up here. My question is this it? Is it hit resistance and then fall? Does it hit and break and go higher? I don't know. But if it rejects, then you're going to have an opportunity to buy this pocket, and you're probably going to have an opportunity to buy this low, right? And it gives traders an opportunity to trade and take profit, accumulate and take profit, maybe accumulate and take profit. And you can do this, a few times. And obviously, like, I still want to have a core position that's going to run to all-time highs. But as far as a trade, like, yeah, I would love to take a trade that is prices down here, do some debit spreads, make some money. Price comes back down here, do some debit spreads, make some money, right? Pretty good trade. If it goes to all-time highs, awesome. Maintain those shares if you have them. So, all right, that is closing bell. I'm trying to think. Tomorrow, I'm actually co-hosting somebody. I'll have a guest. I'll have a guest on tomorrow for my 3 p.m. So come back and join me tomorrow for the final hour. And I'm trying to think to wrap things up. I gave you that little tiny sneak peek of my my dashboard. This is still a prototype. This is a beta right now. But in the next couple weeks, I'm looking to get this finalized, get it labeled. But again, for me, getting ready to trade with roughly however many tickers I want. I could put 1,000 things in this if I want to. But what gets me excited is I can take all that information and find actionable trades. Right? So that way I don't have to do the classic manual scan of like go A to Z and try to find. It's all here. So I'm really pumped about this, and I'll be talking a lot more about this at the end of the month. Okay. What was the last question that came in here? Why not do the wheel on IWM, just the call? Because I already have the shares MP. A wheel strategy is you sell puts, and then you get assigned the puts, and then you do covered calls. We already have the shares. So the wheel strategy is you sell a put, you get a sign, then you do the covered calls. I already have the shares. So I did a buy right instead. So I bought and I wrote a cover call against it, and that's my trade. A couple of my accounts I still had IWM shares in, so I'm just going to continue to monitor those and roll those too. Make sense? All right. Good, good, good. Let's see here. I think that's about it. Asia, positioning early for a couple days, riding it. Okay, fine. So one last checkpoint would be, let's just look at currencies for the day. So today we had the dollar on top, the yen on the bottom. Swiss was also weaker, which I'm kind of happy to see. Let's just do a quick spot check on some currencies. So my Aussie Swiss position, still riding this thing out a little bit longer. CAD Swiss, same thing, riding this out longer. Euro Swiss, riding it out longer. Pound Swiss looking better, trying to take this up to 12.50 to 13.50. New Zealand Swiss, still going to ride this out longer. Dollar Swiss. This also is going to play into a gold correction. Dollar up is good. I did buy some more dollar down here. If we're coming back into it, I got a break even around 8,500 on my dollar positions. So if we come back to this pocket around 8,800, I'm going to take some profit there. I'm saying if you get called away, yeah, it's possible. It's possible. It still ties up the same amount of capital. I mean, because if I just do a sell put, remember, I don't get any price appreciation. I just do an income trade. You know, so if I buy the shares and cover them, it's like I'm getting $3 or $4 a week. If I sell a put, I mean, it depends on if I go at the money or out of the money, right? Because what happens, right? Here's what I say. What happens if I put in a sell put? What happens if I do a sell put right here? So let's say that this is expiration and I get it called away, right? I get it called away. Well, if I wanted to sell a put and I sell it at the money, what happens if I get $3 for that put and then next week price is down, $7? Well, I take the assignment, I lower my cost basis, but I'm now in a hole. So what I'm doing is I'm having a little bit more active management on I'll buy, I have a hedge to protect my own position, and I'll just sell around this to lower the cost basis as much as I possibly can. So I mean, I think we're trying to accomplish the same thing. I'm just trying to do it a little bit more actively, where I'm financing my hedge with covered calls, and once I can clear about $500 worth of covered call income, then that hedge is essentially free, and that hedge will last me until December. So I have plenty of time to be right. If the hedge offers me profit, that's great. But if not, I'm just going to roll and roll and roll and collect as much income as I can on cover calls. Okay. Michael, why don't you just use FinViz and scan, man? If you want to find good companies, then use FinViz, type in some fundamentals, look at, price to earnings are positive, look at growth, look at cash flow, look at debt, look at analyst ratings, look at volume, do a scan and try to find your stocks under $15. That's easy, man. You can do that. Go to FinViz, look at their screener, find some trades. There's quality stuff there. Get a head start. So if you go to screener, and I would go to all, and market cap, I would say you're wanting to look. I don't like trading like smalls and micros. I would say mid or higher. So we'd want to see at least, where's this one at? Over 2 billion. So at least a mid cap or better. Earnings, I want to see positive. So anything profitable on price to earnings is good. EPS the next 5 years, positive, right? Current volume, I'd want to see average volume actually. So we want to go to, let's go, where's my average volume? Average true range, average volume. I want to see at least trading over 1 million shares so it's liquid. And then you can go a price point here. Let me find price. There's some price levels you can screen for. If you have a certain sector you want to trade, that's fine. Here's price. I would say at least, I mean, I don't know if you have an over under, but we can have a range. Custom, you can do whatever you want, but let's just say you're looking at something around, $10 to $50. Well, there you go. I mean, there's at least somewhere to start, but 320 companies, you can maybe get a little bit more precise here. Relative volume, I would probably do something in the, let's see here, 50-day moving average. How far away from the all-time highs? Current volume, anything that's trading, over 1 million. That brings me down to 251. I mean, there's a lot of stocks out there, man. If you want to go large cap, you want to go a little bit larger, so over 10 billion, got 130 stocks that are in that price range, 10 to 50 bucks. But by definition, they're profitable. They're forecasted to grow. If you want to get in some I mean, I don't mind having insider ownership. I would say analyst recommendation. We want to see like a buy or better, and insider ownership. I don't want to see like insider transactions. I want to see at least over 10%, maybe. There you go. So on large cap with insider ownership, which is tough to do on a large cap because these companies are so large. But if your C-suite has over 10% ownership, I mean, we have now 26 companies that are profitable, have forecasted EPS for the next 5 years to be good. Volume is solid. They're liquid, priced out 10 to 20 or 10 to $50. They're recommended to be a buy trade. Check out the industry, the sector. If you want to trade mostly US, that's fine. So country, just do USA. Now we're down to 20 stocks. So literally in 3 minutes, I now have 20 stocks, which is right here. And these would be checking all these boxes for the price point that you're looking at. So there's a screenshot for you. Not necessarily in any order, but you can explore. I mean, of this batch here, I mean, SMCI, I don't know if I love that one. There's other semiconductors I'm more interested in. Pinterest, if they have a big user base, sure. Keurig Dr. Pepper, I have traded that one. I like that. That's kind of the poor man's Coke and Pepsi. Chewy, it's the Amazon of pet food. Carnival Cruise Lines, the more cost effective. I mean, I think people are going to pay for more experiences and travel more so than goods. They'll pay for, travel, services, experiences versus stuff. I hope, especially if stuff is more expensive. Warner Music. I mean, there's a few in there that I would consider, trading. Okay. Yeah, there you go, Penny. Same thing. So, all right, I'm gonna let you go for today. Come back and join me tomorrow, where I'll be having a guest. He has a funny last name. I'm meeting him for the first time in person. So JD and myself will be in for the final hour tomorrow, and off we go. So, all right, everybody, have a good rest of the day, and see you back here mañana. All right, thanks. Bye.